Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. We've got some really good news and some news right now that maybe isn't as exciting, but there's big things coming real quick here. So let's take a look. I'm going to share my screen here with you. And Trump to nominate economic advisor Stephen Moran to be new Fed governor, replacing Kugler. Her seat was up in January. She resigned early. He's taking over. He'll be the seventh of the seven Fed governors on there. This is the third Trump appointment. The other two were Christopher Waller, who's kind of running at the top of the list for the new Fed chair, ahead of where Powell's going to be done by May or sooner. We'll see how that goes. And then he also, of course, put in uh, Bowman. So those are team rate cut people for sure. Stephen Moran was the chair of Council of Economic Advisors currently, going to be replacing Adrian Kugler. So we'll have definitely three out of the four, but there's kind of a mutiny going on right now behind the scenes at the Fed with team lower rates, and I'll get into that more in just a second. But here's something to get ahead of the data a little bit, because what we see from the Fed is usually old, outdated numbers, year over year data, antiquated models, all that good stuff. We had some big news come out of the BLS where the BLS head of the BLS was fired by President Trump. And, you know, we're going to see why here in just a second. But the jobs revisions were 253,000 last week, and the bond market was always ahead of the Fed. And I think even much smarter these days, uh, you know, took that to mean, oh, we're a much weaker, for the dual mandate for the Fed, we're a much weaker jobs economy than originally thought. And I keep telling people, people are like the tariffs, the tariffs, the tariffs, but either the Fed has a dual mandate or they don't. Meaning, they originally, Powell said we're here to, we're got to tame inflation, tame inflation. When we had over 9% inflation under the last administration with all the spending that was going on, too many dollars chasing too few goods, and kind of a ginned up economy by that spending. And then, you know, we see this, retraction in the inflation quite a bit, and they're worried about tariffs and everything. But you either have a dual mandate or you don't. So, people are saying, well, the tariffs are what keeping things stifled for the jobs and economy and everything. And really, I've shown the numbers before with the PP buy index, which is the wholesale index. You've seen those numbers actually go down. A lot of companies have come out and said that they're actually absorbing those costs and stuff. But the other thing is, and if our government's running into black, that means you don't have eventually less dollars chasing those goods, right? So that's a good thing. You want to be in the black. But the other part of the mandate is full job employment, right? So they're stifling that investment in production, even though we have good numbers coming out of CapEx, which it shows the future of what they're putting together for assembly lines and getting ready for AI technologies and all that stuff. Those are all positive numbers forward looking. But in where we come from and where we are now, when we look at Truflation, like yesterday, it was like 1.6 or 7. And Truflation takes even more data points than what the Fed looks at. And basically, in the today numbers, in the current non-antiquated, more of a modern look at the now inflation, we're seeing that 1.6 to 1.7 is kind of where it's been fluctuating. So you can take that for what it will. You don't, you certainly don't have to take my word for it, but they do, for as far as the Fed's concerned, they are looking at old numbers coming out of, maybe a few months, quarters. Shelter costs are always way behind with the Fed. The Bureau of Labor Statistics too, they put out surveys to show you how antiquated this is. They put out surveys for jobs numbers, and about 40% don't return the survey. Why? Antiquated way of doing things. Like fax. You have to send it back by fax. I don't know anybody who's using fax anymore, hardly, except for these government institutions, and or snail mail. So 40% of it's kind of estimated anyway. Well, when they broke it down into the revisions, they had 253,000. Also, I'm going to even show you this new um, some of these new numbers here. I just want you to watch this for a second. And this is some forward-looking numbers that are going to come out in about probably won't really see them in about for about the next 6 months, just to show you how antiquated some of this stuff is.
Thank you very much, everybody. Just a quick session with Steve Moore. Everybody knows Steve Moore with the Heritage Foundation, highly respected, one of the most highly respected economists and people that watch your money and know more about your money in your life than probably anybody I can think of. And I want to thank Steve for being here. I saw this today. They came out. What he puts out gets a lot of coverage, and I saw some of them, and then he had a couple of others. And I'd like to ask Steve maybe to discuss a few of these numbers that were just released. I mean, literally just released. And then we're going over, and we're going to do Purple Heart. We have some incredible, brave people that I look forward to. So we'll do that right after this. Steve, could you say a few words about the various charts?
Thank you, Mr. President. So I called the president because I had some very good news from some new data that we've been able to put together that no one has ever seen before. And I'll just very quickly go through these. So I was telling the president that he did the right thing in calling for a new head of the Bureau of Labor Statistics, because this shows that over the last 2 years of the Biden administration, the BLS overestimated job creation by 1.5 million jobs. That's a gigantic error. And I don't know if she's.
That might not have been an error. That's the bad part. If it was an error, it would be one thing. I don't think it's an error. I think they did it purposely.
Whether that's, you may well be right, but even if it wasn't purposefully, it's incompetence.
Right.
Okay. So 1.5 million jobs overestimated. We have access to the some data that no one else does on what has happened month by month with median household income. This is based on unpublished Census Bureau data. It will be released sometime in the next 6 months, but we get an advanced look at it. And so I was telling the president, in his first 5 months in office, starting in January through the end of June, the average median household income adjusted for inflation for the average family in America is already up $1,174. That's a huge.
Okay, so why am I showing you that? Well, it's very important to understand that the bond market reacts to those job numbers. Why? Because again, the Fed rate, the Fed has that dual mandate, right? So they saw that those numbers were much weaker than originally thought, and now they reacted to it. That's why we saw the 10-year yield come down, and we saw the drop in mortgage rates over the last few days by about 30 basis points. So it's really a big deal, and I'm going to show you a little bit more on that score in just a second. Now, the other thing that we're wondering here is mortgage interest rates dropped today. This was on August 7th. Mortgage rates dropped for 4-month low as pressure mounts on Fed. So everybody's thinking we're probably going to see the Fed cut rates coming up here in September. Most likely they should. Now, remember when we had the Fed drop the Fed fund rate? It's not a direct correlation with mortgage rates, but the 10-year Treasury is traditionally about 175 to 200 points difference between the 10-year and mortgage rates. Mortgage rates usually that much higher. So it's kind of, we call it the slow dance, and those are the spreads between the 10-year and the mortgage rates. So the bond market's already reacted to it. They've been reacting to all these things way before the Fed does. And one thing that I'm going to show you here in just a second will blow your mind on where we are on that. I've been saying they should be, along with other people out there, that they should be at least a neutral policy if they're quote unquote worried about the tariffs, where really they're stifling the production because of the Fed rate, because it just costs more for companies to borrow that money for investing in production and wage growth and things like that. But we already see we're getting some wage growth anyway because of the reduction in taxes, the CapEx coming out, and AI and all those sorts of things. So let's take a look at this a little bit more. This is from E.J. Antoni. He's a great economist I like to follow, just to kind of keep it short and sweet here. Inflation indicators came way down in Q2, thanks in part to lower energy prices, and GDP price index came in just below 2%. Target good news. So in other words, that those wholesale costs are coming down for the people that were worrying about the tariffs. So that's good because then that won't be passed on. Not to say that every sector is that way, but a lot of the sectors are, and they've come right out and said it. Walmart, Ford, just to name a couple. We just saw Apple put in an extra 100 billion in production that they're going to be bringing in over the next 4 years, so 600 billion from them. Total of over 15 trillion in investments coming in, onshoring production here for different sectors. Tech sector is a big one, of course. Somebody was asking me, home price, this is a good one. Home hasn't the interest rate been falling over the last 40 years? It really only goes up if you increase interest rates. If they continually falling, it's going to increase. And Logan Motoshami at Housing Wire said, from 1974 to 1979, home price growth was hotter mortgage rates back then. So, there was actually a hotter period. Right now, we've hit the highest median price in home prices actually across the country. So it's just something to think about. Again, we always bring back the idea that there's only been 6 years out of the 84 years in housing history in the United States where we've seen in red here where there's actually been a decrease of 1% here in 1990 and then the big crash, of course, which we're in totally different territory right now with a quarter of that inventory. We've got different lending practices and people have a ton more equity than they had back then. I mean, I think the average is about 300,000 right now in equity. And then a large percent of the people who own homes actually own them outright, about 40%. So here's the spreads between the 30-year rate and the 10-year yield. Going back to 2015, we talked about the spreads. So we normally like to be here where we normally were, and then COVID hit, and it kind of threw everything into a little bit of a bump. Okay, but they're coming back down now. If these spreads weren't better than they are right now, you'd have much higher interest rates. We were up near 7, you would have had 8% interest rates where the spreads were, but over the last year they've been coming down. Here's the one that I keep bringing up. Besides manufacturing being down overall, over the last year, the last 4 months, we've seen a decrease in residential specialty trade and residential construction. So this is a big one, okay? Because when those two sectors go into a decline, there's usually a recession coming right behind it. Okay, so one thing that would skyrocket that is the Fed's fund rate coming down. And I'm going to show you something here in just a second that will maybe blow your mind a little bit on that. I don't know. I'm kind of a nerd that way. It kind of blew my mind when I actually thought about it and looked at it. But purchase application data increased. Now, this is kind of gives you an idea of what's coming the next 30 to 90 days. Application, people who applied for home loan pre-approvals, okay? Some of them may be listing their home, some of them maybe not. Higher percentage probably are homeowners than first-time home buyers right now when we look at the data. But purchase application data update increased by 2% week over week, increased by 18% year over year. Those are good positives. That means there's more people wanting to go out, buy a house, make a move, achieved 27 consecutive weeks of positive year over year data and recorded 14 consecutive weeks of double-digit year-over-year growth. So that's good forward-looking over the next not up as much as these numbers here, but over week, it's even up 2%. So we can see maybe that slowing part, like big part of that's going to be seasonal, guys. It's just the way the cycle goes. So a little lower number there, but still looking at positive overall data because you kind of have to take it over that entire period and look at kind of where things have been and seasonally. So why 6% mortgage rates will reignite the housing market. Now, this is a big one because we see that, when we've gotten to 6% mortgage rates a few times, right in that range over the last year or so, we've seen mortgage application data rise again. Okay. Even with the seasonal indicators that we have taken in the case. So right now, today, we're running at about 6.5, which I'll talk more about in a second. This is the thing here. The 2-year Treasury right now is at 3.7. Okay. And, normally, again, this is why Powell is way behind the curve. Normally, the 2-year Treasury yield is expected to be higher than the federal funds normally. So right now, you've got a federal funds rate at about 4.2 to 4.5 overnight, numbers that take place, 4.25 to 4.5, and we're at 3.7. So the Fed's fund rate should be lower than this number with the kind of economic, even with the kind of economic data that we have right now with GDP up and stock market, blowing up and all the investment coming in, and with our government being in the black from the tariffs. So again, a neutral policy is where we should be. What's that look like? At least 2.5 to 3.7 is what we've been talking about. And look at right here. The 2-year Treasury is lower than the current Fed's fund rate, which means too slow is being too slow. So when we look at the 10-year, right now we're at 4.2, and today's rate is 6.5. So again, it should be 175 to 200 points difference, and the spreads are getting better overall over the last year, but we're still not quite there. So we're getting there. We're getting there. So bond market's ahead of the Fed. They always will be. The next Fed meeting is going to be in September. Everybody's talking about a rate cut. We should get that rate cut. Now, right now, with the listing successes in the Phoenix area, we're seeing 4 out of 10 are not being sold. So 4 out of 10 listings are not being sold. We just had a little dip the last couple of weeks in active inventory. So let me take a look at this chart here, and we'll see where things might be heading here. We're at 77 days closed on market across the valley for the greater Phoenix area, 3.8 month supply. That's come down a little bit. Okay. Like we just talked about, the absorption rate has gotten a little bit better. That's good, but 4 out of 10 are not making it. The average, so the idea here is when you list your home, you need to list it to sell for the current times. Right now, we're going to talk about what kind of market we're in, but the good news is where we're heading with that mortgage application data and the local data. Okay, we'll show you that in just a second, a little bit more in detail than this chart. But the average list price is 701. The average sales price is 577. That's definitely up a little bit from the last couple of weeks. And a list of sales price data, 97.2. We usually like to see that at about 98. Or a little bit higher, right in the 98 range. But, a part of that is right now, sellers are giving up a little bit in concessions, along with builders. Remember, resale market is a little different than resale and new builds are a little different. New builds are obviously offering all kinds of incentives right now and concessions. Active inventory is down 2%, pending's down 0.9% under contract, and closed units is up 3.6. Okay. So you can see this is broken down by different price points here down in the bottom left. And we can see that what the days on market is in those price points. Now, so right now, what does that mean for our market? Well, let's take a closer look. We have on the Crawford Market Index, 90 to 110 is a balanced market. Below 90 is buyer market. Above 110 is a seller's market. This number has gone up over the last couple of weeks. That's a good sign. So we're getting back to towards a balanced market. Our supply is at 100. Our demand is at 76. And we see that we're heading towards that balance range. Okay. So hang on one second. Okay, sorry about that. Had to let my puppy out. We're seeing that we're heading towards that balance range. And when we look at the different cities right now, Paradise Valley and Chandler are sellers market. And Fountain Hills, Cave Creek, Glendale, Avondale, Scottsdale, Phoenix proper, Mesa, Gilbert, they're all in balanced markets. Tempe, Goodyear, Peoria, Queen Creek, Surprise, Buckeye, and Maricopa City are in buyers markets. This map here kind of tells us our contract ratio list to what's under contract. Right now, there's no hot spots. Everything's just kind of warm, balanced to cold. Okay, so that's kind of where we're at on that score, guys. But the one good thing is we're seeing that there's a mutiny at the Fed. We're seeing forward-looking data that's still looking good. We're kind of going back into a balanced range. We're heading in that direction. And every single city is heading in that direction for the local Phoenix area. So, guys, if you have any questions at all, I would just say, for buyers out there, there's still some really good deals out there if you're looking to sell and buy. No matter what market you're in, you're either in a seller or buyer's market, unless you're totally balanced. You're going to get good or bad going one way or the other, or not as good. But you kind of want to make sure that you're really motivated to sell if you're listening. It's not really a time to wait and see. So let me know if you have any questions. Feel free to reach out with those. I'd love to be able to help you out in any way we can, and talk to you guys soon. Thanks.